Joining us right now to talk strategy ahead of the first trading day of the quarter is Stephanie Link. She is Hightower Chief Investment Strategist, also a CNBC contributor. And Steph, first of all, good morning. What do you make of this OPEC news and what it's doing not only to WTI, but also oil and energy stocks this morning?
Yeah, I mean, it was a big surprise over the weekend. I would say that it's obviously a positive for the energy sector, the complex itself, especially for free cash flow. These companies, even before the news today, still generating a ton of free cash flow. So that to the extent the price goes higher, that's even better for them and shareholder returns, because we know what they're doing with all that free cash flow. They're not doing it in production; they're doing it in share buybacks and dividends. And then on the other hand, it's kind of negative for the consumer if oil prices go higher. The Fed probably is going to continue to go anyway. I looked at the core PCE numbers last week. In the last 3 months, it's running at about 4.6%. So no matter what oil does, they're looking at other parts of inflation, and it stays pretty sticky. So I think this news isn't great in that they'll probably continue to be very hawkish. And of course, the biggest question is the SPR. It's at record lows, and what do they do? They're going to have to do something, and that's also going to put a floor on energy prices. So do you buy, well, first of all, do you own any of these oil stocks already? And would you buy some based on this news? Yes, I do. I am overweight. The benchmark is about, in the S&P 500, it's about a 5% weight in the S&P. I'm at about an 8% overweight in my portfolio. I do own a barbell, Chevron, high-quality, dividend, diversified company. I own Schlumberger, a wonderful technology company hidden inside the firm. And then I also own Diamondback Energy. I would add to all three of them because they are all down anywhere from 9 to 12% year to date, and they trade at like 9-10 times earnings. So they're very attractive. And I think this news today obviously is very much of a positive for them. OK, let's talk the other big theme that we saw through the first quarter, and that was technology doing so well relative to the financials. Is that a trend that you expect to continue in the second quarter? Well, I think there's a place for the portfolio for kind of more of a balanced approach this year. So technology, I get it, right? It was really more of a macro call, I think, why they have outperformed because rates had come down in the first quarter. Inflation had started to come down. You had a flight to safety because of the bank scare, and then also a bit of mean reversion. If you think about it, growth year to date has outperformed value by 12%. But last year, value outperformed growth by 20%. So there was some mean reversion in the first quarter this year as well. That all being said, Becky, I mean, there are great stories and great total addressable markets in technology, right? They have great free cash flow and margin improvements, especially as they're cutting costs. So I get why these stocks have rallied. I think they've moved really far, really fast. I'm inclined to take some profits, especially in something like a Meta, which is up 70%. But I also think in my portfolio, there's a place for balance in that you want to own other things like some industrials. I like the onshoring theme. I like aerospace. I like agriculture. I like the China reopen names within industrials. And then on the consumer side, I think the data we got last week of savings at 4.6%, up from 2.7 from the June lows. We have spending from the consumer at 4%. I think the consumer continues to spend. It's just on services. We know that. And I also like the China services theme for the consumer. You saw the Macau numbers over the weekend. Yeah. We got the PMI services numbers last week. So I think there are places to diversify within the portfolio.